I think we'll make a start, if everyone can hear me. Yeah. So my name is David Jones. I write a couple of weekly columns for Shares magazine. I write a foreign exchange currency column and a Chartist column at Shares. And 3 days a week, I'm on the BBC, Wake Up to Money, 5:15 in the morning, doing lots of personal finance, market stuff. If it's a bit early for you, there's a podcast you can download. So make sure you subscribe to that. It's always I think, an entertaining show. But today, I'm here to talk about charts that work in bull or bear markets. Before I did what I'm doing now, for many years, I worked in the spread betting, the CFD, the foreign exchange trading industry. So part of my job there was to give presentations like this. And I would let you in a little secret, which horrified Mike when I told him half an hour ago. Every presentation I give, it's the same presentation. Yeah? They'll say, look, can you come and talk about this? Sure. So I'll change the front page of the slides, and then the rest of the presentation is exactly the same as every other presentation I do. Because, and there's a very good reason for this, because there is stuff that works time and again, regardless of what the market is doing. So if you watched the presentation I did here last year, today there's a similar structure, but there are a few changes. And what I'm also going to do, there were about 5 shares we looked at last year based on this principle. So I'm going to see how well they've done over the last 12 months based on this idea of looking at trends. So isn't that exciting? It is exciting. I was surprised by the results, and not much surprises me, but we'll do that when we go through. But before we go, before we start, this is nicked from my old job when I used to talk to people who wanted to trade currencies and stuff. How good are people at figuring out the direction of markets? It's a really interesting article, this, and the research was done by FXCM, who are a broker. I didn't work for FXCM, I worked for IG. But they did this, and it's all publicly available on their website. But they looked, because of course, the classic thing about trading, most people lose money. This is true, and I used to be always open about that when I worked at IG and CMC. Most people will lose money trading, right? This is a fact of life. If you look at every month, every quarter in the US, the brokers have to release their results. How profitable will your clients be? And it's always the same. Over a 3-month period, 2/3 of clients lose, 1/3 of clients will have been profitable. But FXCM did some research. They looked at something like 14 million trades over a period of, I think, a year and a half. And this does tie into what we're talking about today about investing. But they said, right, out of all the trades all these people have done, how often were they right? So how often did the trades make a profit? And maybe surprisingly, the results is slightly better than flipping a coin. So if we look at, for example, I think this laser thing, it works, but that's not too well. If we start, the one that people were worse on was the Australian dollar against the Japanese yen. And only 49% of trades on that came out right. So 51% were wrong. But everything else was much better. New Zealand dollar, US dollar, 54% of trades were correct. If we look at euro dollar, 59% of trades were correct. Pound against the dollar, people were really good. 64% of trades were correct. Yeah, so something more than 6 out of 10 trades. So this doesn't make sense, though, doesn't it? So if people are actually quite good at figuring out, well, which way is the market going to go, why do most people lose money? And this is the reason why. It's the average loss versus the average winner. So when people are right, how much they make versus how much they lose when they're wrong. So if we look at euro dollar, the average trade made 65 points profit, but the average losing trade lost 127 points. So it's almost 2 to 1. So if they're making 100 quid, they're losing 200 quid when the trades are going wrong. So it doesn't matter if you're right 6 times out of 10. That is a losing strategy, because the 6 times you're right, you're making 600 quid overall, and the 4 times you're wrong, you're losing 800 quid overall. So you're losing money. Yeah, and one of the big reasons is, you see it, I used to see it time and again from the other side of the fence, from working at a broker, people trade against trends. Yeah, markets will do that, and people, if you look at the net position, which way are clients, they are short. I bet if you looked at oil over the last 3 months, the majority of people trading it via a broker would be long. They'd be looking for the market to bounce back, because people just cannot trade with trends. And it's difficult to do maybe in the beginning, but it is a profitable way of trading, which takes me back, to the subject of today, charts that work in bull or bear markets, whether the market's going up or down, following a trend should work. So let's take a look. Charts. So I qualified as a technical analyst back in 1995. There's a Society of Technical Analysts, and they do an exam every year, and it's a professionally recognised qualification. And I worked as a currency technical analyst. That's how I started my career, doing that. But I do think charting is overcomplicated by too many people. So stuff like, you heard of Fibonacci, Elliott wave, Gann analysis? It's all cobblers. It's utterly ridiculous. It really just, I've got absolutely no patience with it at all. And you see these people with so many lines on a chart, you can hardly see where the price is. And the price is the important thing. So I think it's far too overcomplicated. So I do understand all this stuff. So I speak, from knowing how this stuff works, but I still think it's cobblers. And there are plenty of people, chartists, who feel the same way about the more esoteric approach to charting. It is all about investor psychology rather than magic systems. There's no magic system that's going to be right all the time. And I think that's a difficult thing for lots of people to deal with when they start investing or trading, because they want to find a magic bullet, a silver bullet. And there are lots of people out there, of course, who will sell you a training course that promises a silver bullet or some software that promises a silver bullet. But that, again, that is cobblers. But you don't need to be right all the time to make money. What we're trying to do is, whether we're investing or trading, is point number 3. We're just trying to stack the odds in our favour. So for me, the very, going back to what we were talking about there, one of the filters I look for, apart from the dividend side of things, the share has to have been going up for the last 12 months and the last 6 months. So if it doesn't meet that criteria, then it doesn't get on the shortlist to maybe for me to buy it. Because again, it's about trying to stack the odds. If you can find a market that's been going up for 5 years, going up for 3 years, going up for a year, going up for 6 months, going up for the last 3 months, you'd be really unlucky to end up buying and it goes down, over a longer period of time. Clearly, it can happen. Trends end, but it's all about trying to invest in the direction of the trend. But what people do, they end up buying these stocks that are doing that, and they wonder why it carried on going down. Well, it was going down for months before you bought it. Just because you shoved it in your ISA didn't really change anything. It's still a crap share. Just because you've decided it's not, it doesn't really matter. The market is bigger than we are, and that's the idea of trading with trends. So it's not rocket science. You've got to just be disciplined. It's easier said than done, obviously, but you've just got to be disciplined and look to trade with the trend. And the 3 most important bits for me is that trend, trend, trend. Those are the 3 most important things. So let's have a look at some of this stuff. Who can spot a trend on that chart? Yes? This is new, this bit. These aren't charts from last year. Right? But if we'd have looked at it last year, interestingly enough, if we put on our Harry Hindsight hat on, it was still in an uptrend last year. It was still going up last year. So what's the trend in that? So let's not even worry about who they are or what they make. Yeah? The trend is clearly up. So for me, it's worthy of further investigation. So that's Marshall's PLC, and it took me about 5 minutes to find these trends. Yeah, it's not. There are still trends out there, even though markets have got quite a bit more wobbly in recent months. So the trend is clearly up. So the question for me is, well, the trend's clearly up. I want to be a buyer. Can I get in and have a sensible stop loss? And we'll look at this in a second. But that, for me, that's the first most important thing. I don't want to be the pioneer trying to buy stuff that's falling and trying to bet on when that trend is going to end. I want to try and make it easy and buy stuff that people like anyway, buy stuff that's going up and try and ride a bit more of that trend for as long as possible. Can we spot a trend in that one? Who's that? Nove group, whoever they are. Yeah, so again, I think we can see it's a very clear uptrend. But buying into strength, I think it does scare a lot of people, because they think, well, if I buy it now, I'm going to be buying at the top, it's going to go down. And that is going to happen occasionally, but not very often. If you're buying into trends. Clearly, if markets suddenly crashed, if China opened up 35% lower on Monday and markets crashed 10-15%, that is going to affect the trends. But for now, that trend is a good solid trend. Who can spot a trend there? Can you spot trends? Do you want me to put some Fibonacci on it? Or put their PE ratio on it? Yeah, or any of that? What's the trend in that? Down. That's Glencore. So Glencore had a lot of press this week because they're going to try and pay down the amount of debt they've got. But since they floated, it's been almost one-way traffic for Glencore. And clearly it's the rout in commodities has clearly affected them. But again, it's not suddenly gone from £3 to £1.30. They're the worst performing FTSE 100 company this year, Glencore. So they've not suddenly gone from here in the blink of an eye. Markets take a while to get to where they're going to. So as a trend follower, we want to try and identify that trend and jump on board and try and ride the trend as long as possible, which again is easy to say, but I think there are some fairly simple rules you can put in place, to try and capture this sort of thing. So that's Glencore, great example of a downtrend. And you might think, well, they've fallen from £3 to £1.30. How much lower can they go? Well, they can go down another £1.30, can't they? They could, they're probably not going to go bankrupt. But then the same way, 10 years ago, HBOS, RBS, Barclays weren't going to have 80% of their value wiped away. Who knows what could happen? And I think it's a much calmer approach to investing to try and find stuff that looks like that, rather than trying to be, the clever one who picks the absolute bottom in Glencore. So for me, I would still be, if someone says, right, you've got to do a trade on Glencore, I'd be short Glencore, expecting it to fall further. Yeah, I think it bounced back on one day when it announced this debt repayment thing, but it went down again the day after Glencore. So it still looks a bit, and if things do change, again, it's not suddenly going to go from £1.30 to £3. If Glencore's share price starts doing well again, I think there'll be plenty of opportunity to jump back in on the way up. The same way, if you wanted to short it, there was plenty of opportunity to go short on the way down. So, and there's another one, Serco Group. There's another one. So Serco have gone from a £5 to £1.06 now, and that's in the space of 18 months, 2 years or so. But again, a very clear trend. Those gaps do suggest there was maybe some profit warnings, I'm guessing, coming in there, because suddenly they closed there one day and bang, opened there the next day. So some big gaps down. So that's again, that would be another barge pole share for me. No matter how good the story is, how pretty the management look, if the market doesn't like them, the market does not like Serco. So who am I to disagree with the market? Not with my money. Does it really work? So this is So I dug out the presentation from last year, which wasn't hard because I had it in front of me and I was updating it, of course, with more up-to-date charts because I was doing exactly the same presentation. So I dug out the one from last year, and the same way while we whizzed through lots of charts here, we did the same thing a year ago. So Dixon's car phone was one example last year. I said, oh, look at this trend, it's an uptrend. So this time last year, it was £3.71. As of the end of last week, it was £4.15. So the trend in Dixon's continued. It was up 11%. Polar Cap Technology, I think they're an investment trust. Again, they're an example. They were 505. They were 558p on the 7th of September. They're up 11%. Oxford Instruments, I said they were in a downtrend, like Glencore and Serco. So they're in a downtrend at £11.78 a year ago. They're now 809p, so that's another 31% move in favour of the trend. DCC, whoever they are, their trend was up last year, 34.85. They're 48.38 now, so they went up 39% from where they were a year ago. National Grid, uptrend, clear uptrend last year. They have wobbled. They were 9.10 a year ago. They're £8.53 now, so that's down 6%. And finally, ITV was another example in this presentation from a year ago, at £2.20, and they're £2.44. So they're up, they've moved 11% since a year ago. So the average, based on the trend, the charts we chucked up, the average return was 16%. The FTSE All Share is down 7%. Needless to say, I never bought any of these after talking about them. Okay, so I've not made any money out of it. But hopefully, it does demonstrate, even the FTSE's down 7%, FTSE All Share is down 7% over the last year. There have been charts that bucked that trend, and they were picked the same way I picked the ones for this year's presentation. Look at a chart, is it pretty, is it an uptrend? Yes, bang, in it goes. Yeah, so if you trade with the trend, it's such a big step to stacking odds in your favour, rather than going out there and buying some share that's been in free fall for years, but lots of people talk about it on a bulletin board and they think it's going to, strike uranium in Cornwall soon or something, whatever it is these stupid little companies do. So it's much better to try and identify the ones that are trending. And it is getting harder. It's much harder now than it was a year ago because of the wobbles we've seen in the markets, but the opportunities are still there. So what I look for, trend and big levels. So for me, the filter, first of all, has it gone up for the last 12 months? Has it gone up for the last 6 months? And normally, there's about, if I look at the FTSE All share, normally there's at least a couple of hundred shares in normal circumstances that meet that criteria. So then it's just about doing a bit more work on the chart. So for me, Marshalls, this was the first example we looked at the beginning. So Marshalls, clearly the trend is up, and the classic way of identifying a trend, if you're a chartist, you put a trend line underneath the lows. You don't put one going through, because that doesn't mean anything, but it goes underneath the lows. So the assumption is, if we sell off like we have, nothing moves in a straight line. If you get sell-offs, there should be support there. The buyers should come back in. So that's the first level to look at. And the next thing I look at is big levels. We talked with Mike and Roger talking about stop losses. So for me, if a stop loss is more than 15% away, then I can't buy the share. But the thing I base the stop loss on is that sort of a major dip just before where we are now. So 358 was where they closed on whenever it was, the 7th of September. So for me, my stop loss is going to go below there, which is probably somewhere below 290. So let's say 280. So that would be too far away. So for me at 358, I couldn't buy them because the stop loss is 20% away from where the price is. If they drop back down, I'd happily buy them here because the trend is still up and it's above my stop loss. Yeah. So for me, it's looking at drawing a trend line on, and look at these levels, these big levels, they should really jump out at you. I think the mistake that I made in the beginning, I think plenty of us make, you end up squinting at charts, for like 10, 15 minutes, drawing all your various lines. But I think if you're a longer-term investor, what do you care what it's done over the last week? If you're looking to hold a share for a year, 2 years, you shouldn't get bogged down with the day-to-day movements. It's the bigger picture. So I'm looking for a big, obvious level that jumps out at me, and my stop loss goes below there. Buy the share, and that's it. Here's another one. So this is a short. If you want to go short, Home Retail Group, who do they own? Is it Argos and B&Q? I think they own, isn't it? Yeah. So a great downtrend. So again, the principles from before turned on their heads because the market's going down. So when the market's going down in home retail, so we've got our trend line sitting on top. So again, the assumption is, so this is clearly a bear market. The assumption is any rallies will run out of steam here is one level to watch. But for me, the absolute big level, look at these highs from earlier this year. So it's just banging up against sort of 175, 180, would not get through. No one wanted to buy home retail shares at 175. Yeah, it was just like bang, sell, 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 and down they went. So for me, if they broke that trend line, that's the first sign that maybe things are changing, but they really need to break through this level for it to start to look interesting to me. I've got no interest in trying to be the pioneer who's going to try and predict the bottom. I want to see them turn around. So for me, if it rallies up into here, I want to be short. I want to sell them short and try and profit from them falling. But I don't do that in my long-term investing stuff. We do that with a spread bet or a contract for difference. But for me, while they're below here, the trend is definitely down. And you don't argue with the trends. Here's another one, BT Group. So this is this is a really interesting one actually, just because of where it is. So the trend back to September 2012, so 3 years, BT has been going up on this particular view. We've got our trend line in place, and as of the 7th of September, it's come back and it's tickled that trend line. So again, for me, if I want to buy it here, and I would buy it because clearly the trend is up, I want to have my stop loss below what's going to be a big level. You could say that these levels back here are big levels. These are the lows from 2014. But the closest I'd want my stop loss is here, which looks like the low right at the start of this year. So about 380. So if I was a buyer at 425, I might have a stop loss at 370. So that's 55p away. So for me, that works because that's less than 15% away. So for me, and I try and buy shares every month. So for me, BT could be a potential one, next week. If I looked at it next week and we were still here, and I'm assuming the dividend yield on BT is maybe a couple of percent, I'd guess, something like that, and the trend is up. So it looks like potentially an interesting opportunity. None of this stuff is rocket science, but most people, I do think ignore it, particularly when it comes to the trading world. They all ignore, well, not all of them, but too many of them ignore the trend. But I think in investing, you can make your life a little bit easier by buying stuff that clearly the market likes. And when I talked about it last year, I said my average return over the previous 4 years, it's not making like a fortune, but it's about 14 to 15% a year return. So again, for me, when interest rates are low, and I'm investing in mainly sort of blue chip or FTSE 250 type stocks, that's a reasonable rate of return. It will change. It has changed this year with the wobbles this year. It's been a struggle, this year. And I think the bull market is still in place, but if markets did sell off, like I said earlier on, I would be quite happily get out of everything if it hit stop loss. So I think we've got an interesting few months ahead, but there are still interesting shares. I think where the trend is most definitely up. Okay, that's it. I can't believe I finished in about 8 minutes before I was meant to. But this, I could sit here and go through charts all day. There are charts like this still out there. It's exactly this sort of stuff that I cover every week at Shares Magazine. So my bit is towards the back of the magazine, and there's normally two charts a week that we'll look at in here. So if you're not a subscriber to Shares Magazine, then clearly you should be, and we cover this sort of stuff every week. And also I do a column on currency trends. I don't want to make it sound like a magic system. Still, things go wrong. I'm trying to think of stuff. What did I buy? Daily Mail and General Trust. So I bought Daily Mail and General Trust at the beginning of July, and their trend was fine. 2 weeks later, when they announced their results, they did come out with, I think, what was in effect a small profit warning. So I sold them very quickly after that. So I held them for 2 or 3 weeks. But I've got longer term stuff in my portfolio, like Sky, the media company, have been in there for 1.5 years because they've got a cracking trend. Reed Elsevier have been in there for a couple of years. There are some of the tobacco companies, of course, have fantastic trends. If you don't have an ethical problem investing in tobacco companies, they have some great trends out there. The likes of British Land and Land Securities, the Barratt Developments, those sort of companies. The land companies have done really well as well. So there are opportunities out there. You don't need to be scrabbling around stuff that's in decline. You can find stuff where the trend is in your favour. So I think that's it for me. If you have any questions, you can, clearly I'll be around for a bit, but you can drop me an email, dj@jonesdc.com. You can follow me on Twitter, and on Twitter I am Jones the Markets. Twitter, if you're not on Twitter, it's very good for financial news, particularly for breaking news and analyst views, that sort of stuff. 90% of what is on Twitter, again, is utter rubbish, so you've got to be able to filter out a lot of the noise. But I was very skeptical about Twitter before I joined it, and now if anything moves, if a share price moves or the markets move, it's one of the first things I look at. So I think it is a very useful tool for investing and breaking news if you can filter out some of the rubbish from there. And that's it. So I hope you found it useful. It's not rocket science, but trading with the trend is a fantastic way, as those figures from 1 year ago showed, of trying to stack those odds in your favour. Okay, thank you very much.